guys, welcome back to the Capital Mindset Show. Today, we're going to be doing another subscriber request, and that is NVR. So for those of you who don't know, NVR is a home builder, and with that comes some added nuances. Now, that home builder video, I still owe you guys that one, so that one's still coming. And this one is going to be released along with another one that's kind of more pertinent in terms of timing, but this one is a subscriber request. So with NVR, what we're looking at is one of the larger home builders, about a market cap about $15–16 billion. We see this massive run up if you take a look at the longer time period. But more recently, we have seen a bit of a pullback right here down here, about 20%. And then again, a more recent pullback now with all the turbulence going on in the market. So what are we getting when we buy NVR? Well, we are getting, again, one of the larger home builders. And it's not the largest home builder, but it still is a large home builder. And we see this massive price. So I'll actually go ahead and take the time to say, for those of you who are newer to the markets, I hope this doesn't dissuade you entirely, okay? Especially in the era where we do have fractional shares. But I know that some beginners, occasionally they think that the larger share price equals expensive. And it's a psychological thing, really, because you think $4,700 is expensive, but relative to what? Because remember, here we invest in businesses. So the price is relative. Relative to what? Relative to the cash flows, the earnings, et cetera. So right from this, that's basically what I'm going to say about that. But from here, we're going to go over to the earnings overview, or let's actually take a look at an overview of the business according to the business itself. So they are headquartered in Reston, Virginia. So that's how you can get an idea of what are they dealing with in their corporate offices. Nothing too fancy. This is actually what we're here for. We're here to look at the different brands that they have. They have NV Homes, Heartland Homes, and Ryan Homes. So just because you are, as the home buyer, you're dealing with any of these brands doesn't mean you're dealing with a different company. You're all dealing with the same company. Okay, so there are some key things, and we're going to take a look at their financial statements, starting with the assets right here. So the consolidated balance sheet. I'm going to talk about a little bit about each line item, because with these kinds of entities, I'm going to touch upon this a little bit more in depth in the home building video. But with this particular company, I want to point out inventory to you guys. So this company is in the business of selling homes. So the inventory portion is actually real estate itself. So we see they separate it for us very nicely. Lots, right? Unsold lots. Okay. And by the way, take a look at this: covered under sale agreements with customers. So that is already sold. Okay. So that's just we haven't received the cash yet, but we have agreements, right? We haven't given it over. We haven't given the keys over. So this is unsold, right? Unsold lots and housing units, land under development, right? So these are future properties or future parts of inventory, and then building materials and other. So in reality, we want to think of the inventory as land, and we have to develop this land and build a property on it and then sell it. Okay. So we want eventually all to convert to this. Okay. So with a property development, there's a lot of risks that are involved. And if you are a property developer, you may kind of feel free to chime in here in the comment section. But essentially, with property development, you have to have a longer term vision. And a lot of times the projects are risky in the sense that it takes a long time for you to realize the fruits of your labor. And so if you make a mistake, it could be very detrimental. Okay. So it's actually very important. And a lot of these businesses, they last so long because they're very good at allocating risk accordingly. So the best property developers are very good risk allocators as well. Okay. So it is a skill. And then I commend you, by the way, if you are a very successful property developer. Contract land deposits. Okay. So these are the deposits, property, plant, and equipment. So this is not to be confused with the actual inventory land. They do own a lot of land, but that's not actually under the property, plant, and equipment, because this is for the business operations, not for the inventory itself. So think of it like the headquarters, for example, just as a, well, actually, the headquarters may or may not be in the right of use assets because it's probably under a lease agreement. But you get what I mean. It's property, plant, and equipment. It's things that they own for business purposes, not for, actually, a good one would be like a van. They own a van, and then that van is the company van, right? So that's covered under property, plant, and equipment. And then operating lease right of use assets, those are like the lease agreements that they have and stuff like that. All right. So they also have a banking unit. So they do have a branch within their business that does actually help out consumers to afford their properties. So with that, we have cash and cash equivalents, all separated nicely because that's separate from the main business right here, cash and cash equivalents in the total. In the home building sector, they have the mortgage banking sector. So what are the benefits of the mortgage banking sector? Well, more margins at the end of the day, because remember, the more relationships we have, the more people are dipping into the pot. So you could say that they're probably doing that to increase their margins. But however, the other face of the coin is you add risk, right? What kinds of risk do you have? Well, you have default risk that you add this back in. And then you have restricted cash, obviously, for a financial entity, and then mortgage loans held for sale. So this is to be expected. I don't expect these kinds of entities to want to hold the mortgages. Okay. So they want to develop that relationship, make it easy for the customer. And then they want to sell it out, because if they don't sell it out, and it's held for sale, by the way, that's how we know they're going to sell it. It's held for sale. We want to sell it out to de-risk the balance sheet. So all this, the way I see it, is it's risk that they don't necessarily need. And I would rather, as an investor, want them to get rid of that, right? So not all customers are going to come and do a mortgage loan with us. They'll come in with a bank, et cetera. But as long as we get our money, that's what we really care about. These, I just want them to get rid of those and then invest it back into new properties, et cetera, and continue growing the property. Sorry, the business, not the property. So anyways, regarding this actually is an interesting line item. That might be stuff that they recollected or stuff like that because of the mortgages. Or it's just actually the property and equipment. Actually, I'm leaning on it's property and equipment relative to that business in particular, not what they've reclaimed. They wouldn't put that there. And then, yeah, because it's operating lease. Yeah, it's the second one, guys. So sometimes we have to kind of think because, different financial statements they use some varying amounts of names, but regardless, let's go over here to the balance sheet, continuing. And then this is the home building. Then again, this is mortgage banking, home building. Yeah, this is the shareholders' equity. We don't need that. I want to go to the income statement, which is right in front of us. All right. So in the income statement, obviously the majority of their business is going to be from the home building sector. And we can see that this constitutes the larger share, the lion's share of the revenues. And then if we look at mortgage banking down here, we see mortgage banking fees. Remember, like I said, the advantage is that they don't have those people taking from the pot. It's just them. You have a full relationship with NVR, right? So if you do a loan with NVR, well, they're handling all those fees. They make all those fees, not a different bank, right? More income for us. However, we do take on that added risk. But remember, as we go back up here, they are trying to sell those out, right? Held for sale, right? We don't want to keep those on our balance sheet longer term. All right. And then this is the statement of income, the income statement. Misspoke there. So we want to see, we can see, the end income is, of course, the lion's share, as is the revenue. Okay. And then the net income, okay, it's growing nicely. But I just want to point out those little accounting details and go to statement of cash flows. But statement of cash flows is going to be more or less fine. But yeah, it's fine. We kind of this kind of makes sense that the net cash provided by operating activities is more or less in line with the net income at the end of the day. So that's good to see. Okay. So from there, we're actually going to go over to the model. All right, so we're taking a look at the model over here, and I already actually plugged in some growth rates for us. So what I want to actually highlight is let's actually look at the implied rate of return. It's 12%. I'm going to showcase some new features today. And this one over here is not working temporarily. I got to actually fix that one. So sorry, I can't show you the gender of the management team and whatever. It's for those of you who like to see that. But looking at this business, I want to actually highlight that at present moment, it's kind of fair value. If we look at the market average rate of return, I assume it's going to do that. Yeah, it is. So if we assume market average rate of return, it is more or less at fair value territory for very little growth. However, if we want that added margin of safety, about 15%, you can kind of see him. And we started off at 12. So that pretty much covers that real quick. And then the Altman Z-score, it is implying it's safety. I actually did say that we do not know which of these scenarios is more likely. So I put a no there. And then let's go back to that 12%. You guys visualize that. So it says about negative 0.2% should be allocated to the portfolio. It's basically nothing. And then 10%, it says 2.69 if you think all these scenarios are equally as likely. Of course, so looking at something like this, it is looking cheap. They have had really good metrics on return. We'll actually take a look at that in the ratios, but I want to actually come down here to kind of visualize what's been going on with revenue. Revenue has been rising steadily over time. Cash flows have had this trough over here in 2014, but over time, it still has also gone up. And I'll actually zoom in just in case for you guys. And then looking down at shares outstanding, they have cannibalized the shares nicely over time, really drawing down. So each time that they buy those shares back, you're owning more and more of the business. So they're deleting the shares. And each time they do that, again, you own more of it. All right. So let's actually take a look at one of these. Well, let's look at ratios first. So I've actually updated the ratio section. So it actually ports in more data. So it calculates for the past 10 years. The one that's still not done actually is unfortunately the activity ratios. But looking at the current ratio, we do see some improvement. And actually, if this is too much, I can just do this. And then I just put in only 5 years. And if I just click that again, we get the 10 years. So I'll stay with 5 years for now to keep it like the past. But in the future, I will sometimes allocate for a 5-year look just in case in when it's needed. So looking at here again, we see actually in real time, I'll just do this because that's nasty looking at all those decimals. All right, looks much better that way. So liquidity ratios, the current ratio is actually improving, very nice. Cash ratio is improving, very nice. So that's very positive. Looking down at the solvency ratios, things are about the same in the total debt ratio. Long-term debt ratio, things are about the same, a little bit worse, but it's not that much worse. Long-term debt to capital, a little bit worse as well, but again, nothing crazy. Debt to equity, financial leverage. So this is a new metric that I just added in because it's nice to know. So they're a little bit levered, you would say, but not too much in that sense. So interest coverage is very good. So I think this is a very healthy company. Looking back at the bankruptcy analysis risks, it said it's not at risk of bankruptcy within the next 3 years. I would tend to agree with that, just looking at this with my eyes. All right, so DuPont analysis, we can see that they do have pretty good margins. Relative to other home builders, it's more or less in line. Operating margins are pretty good. Net profit, pretty good. This is where I think they shine as an ROE and an ROA. Very good. That's indicative of a good company. ROIC is very good. For this kind of company, I'd prefer them to keep the cash. So clearly they're investing very well. Like we said, if you're a property developer, what you're essentially doing is you're allocating capital, mitigating risks. This company's been doing a good job of that thus far. And actually, let's take a look now at that 10-year. We summoned forth the 10-year, and we see that the ROIC actually has improved drastically from 2015. So we may have actually come out of a trough for them right here. If we can see 2014, because of these longer term cycles, and now they're at the higher end of the cycle with 2011 having 18%, and that's just coming out of the recession, right? So let's actually put it back in the void, and then we're pretty much done with that. All right, so going to the right over here, I can see the sentiment report. This is the new thing I want to show you guys. So something like this isn't going to get a lot of mentions, so therefore it only got a mention on Reddit. It didn't get a mention on Twitter, StockTwits, or Yahoo Finance in the last measure. Okay, so you guys want to actually up that go ahead and tweet about it, and then it'll probably show up. Of course, it's not going to show a link, don't worry about that, but it'll say that someone mentioned the actual stock. And then sentiment score is pretty, it's good for what it is. Okay, so it means it's a good sentiment. Okay, over here we can you can pause here and kind of read this. I don't think it's really important, but it's not really overly bullish, overly bearish, or anything like that, which is what we look to this for. So I think on that note, going back here, it's fairly priced. It's not like a huge bargain at the moment, but it's not overly expensive. The home builders, they are looking cheap on a visualization standpoint regarding to looking at simply PE ratios relative to the rest of the market. However, there's a little bit more to the story. You got to actually understand where we are in the cycle if you want to participate in something like this, or that's why at least what I think someone should really understand before thinking about participating in an entity like this. But this is not a bad business. Home builders aren't necessarily a bad business. We looked at companies in the past a little bit, but there's other companies like Toll Brothers, Meritage Homes, etc. And these are, I just mentioned two that are a little bit smaller than this one. And then of course there's bigger ones like Lennar, but these businesses, again, I'll cover more in depth in the home builder video, which I'll be basically going over their accounting and things to look out for, stuff like that. But on that note, guys, I hope you guys enjoyed this video. If you did, go ahead and feel free to leave a like. And subscribe if you're not subscribed, and then you can come back to this channel and we'll be covering a stock that you're looking into, right? And then you can hear a different perspective. So also, if you guys have any questions, comment down below. Any of the accounting stuff, maybe a little bit confusing, either I'll try to answer in a timely manner, but I do notice that a lot of the community, they are starting to respond more to each other. We're building this community here. And if you guys have any requests, go ahead and leave them down in the comments below. I am working on something that will launch soon. That's basically going to be a way to kind of keep track of all the, like a voting measure of what the new requests will be. And in this way, I can have it a little bit more organized and also kind of prioritize it by basically what the community desires. Okay. And, I'll be, of course, picking my own that I want to do, but also looking at what the community wants to prioritize. That way I'm also covering stocks that no one really, unfortunately cares about, just in case. So I'm not only covering what everyone wants at the same time. So we do have many days of the week. So I think I can do that. Okay. For you guys. On that note, guys, I hope to see you guys on the next one. And I hope you guys have a great weekend. Bye.